Welcome back. First time Homebuyer Fridays. What is the deal with appraisals? What are appraisals and what's an appraiser and how does that impact me as a home buyer? What difference does it make what the home appraises for? All right, well, let's talk about what an appraisal is. All right. Appraisal is your lender's assurance that the home is going to be worth what you paid for it. Okay, so a couple things. Let's unpack that. The appraisal is something the lender is requiring in most cases, depending on your down payment and the price of the house. But for most people, they're going to demand an appraisal, which is going to cost you $800 or so, right? The appraiser is going to come to the house. The appraiser is going to spend 15 minutes at the house tops. Look around, make sure that, the water tank is strapped, right? In Washington, that's a big deal, that there are carbon monoxide detectors available, things like that. There are certain requirements that various states have to make sure that the home is lendable. They're not doing an inspection. They're not going to get in the roof. They're not going to get in the attic. They might look at the crawl space depending on the kind of loan that you're getting, but they're not doing an inspection. They're just getting the general lay of the land to make sure that the house meets minimum requirements. Depending on the loan you get, a VA appraiser is much more stringent, has much more stringent requirements than an FHA appraiser, and they have much more stringent requirements than a conventional loan. So the same lender, but depending on the different kind of loan that you got, is going to have different requirements for the appraisal to meet. They're just more careful with a VA than they are with an FHA, than they are with a conventional. And of course, with cash, there is no appraisal because there's no lender involved. So the lender is just making sure that the house meets the requirement of the loan, all right? Then they're going to go back and they're going to work in their office and pull what are called comps, comparable properties. Usually within a mile, sold within 6 months or a year, within a certain size differential of your house, 200, 300, 400 square feet, bigger and smaller, 5, 10 years, younger and older. Get a range, okay? And then they have standards by which they adjust the value. So the house they're comparing, your house becomes a subject property, the one you're offering becomes a subject property, and then they're going to look, say that this comparable has an extra bedroom, so therefore it's worth X more than your house, and they'll take that off the sale price. And they're looking at homes that were sold in that range to determine how much your home is worth. There's a pitfall for you as the buyer to think the dollar amount they come up with is what the home is worth. No, the home is worth what you and the seller agreed to. Why? Because that's the definition of market value. The home was on the market, you offered it, the seller accepted it. That's market value. Now, so if the appraisal comes in low, okay, it doesn't mean the home wasn't worth what you paid for it to you. It means it's not worth it to the lender. The lender can't justify that price. So you got to work out the difference with the seller. The seller either needs to come down in price, you need to come up in your down payment, or you need to meet in the middle, or you got to cancel the deal. There's no other way to get that to work, okay? If the lender's not going to lend you more than the appraisal says it's worth, doesn't mean it's not worth it to you. Doesn't mean if you come up with additional down payment, you're overpaying for the house. It does not mean you're overpaying for the house. It means it's worth more to you than it is to the appraiser, than the appraiser thinks it's worth on the open market. Almost all those times that happens, I'm afraid that the appraiser is just looking at something that you are not, because generally my clients are in the market for long enough to know this house really was worth what they offered on it. Because it can't quite be justified, usually happens in a very hot market where the housing prices haven't caught up, the sold prices haven't caught up with what things are selling for now. And in a very hot market, that happens. The homes are selling for now more than the ones that closed 30 days ago. So the price can't quite be justified yet. But there you go. You got to work that out. Okay, you got to somehow work out with the seller how you're going to work out that discrepancy. It may mean you lose the house. It may mean you pay more down payment. It could mean that the seller lowers their price to match the appraisal, or somewhat in between. But that appraisal matters, okay, because it gives the lender the permission to lend you what you offered on the house, okay? Now, the other aspect of the appraisal is that it could come in over your value, in which case you just walked into equity. Yay, you, okay? If you offered 400, it comes in at 415. Go team. That's fabulous. That means you have $15,000. It means if you refied tomorrow, you'd be able to pull out $15,000. You're not going to. It costs you too much to do that. But it means you got a deal in the bank size. That's great. You wouldn't tell the seller that the house appraised for over. You only tell the seller if the house appraises under. Okay? Now, the other thing to know about the appraisal is it's almost never going to come in just a few $1,000s off. It's got to come in 2, 3, 4% different. Why? Because if it's really close, the appraiser is just going to round it up to the price you paid for it. There's no reason for you to pay $400 and for the appraiser to go, no, it's only worth $395. It's not that big of a difference. So they're not giving you an exact price. Okay? They're not giving you the exact amount the house is worth. They're giving you, yeah, I can get that it would resell for this. So it's going to be different. If it's going to be different, it's going to be different by, 3% or more, something like that. Okay? Not just a couple of bucks. Then once the appraisal comes in, the appraiser could also call out certain conditions. So like I said, if the water tank is not strapped, the appraiser could say, this appraises at the sale price, it's in at value, but I need the water tank strapped and I need carbon monoxide detectors. Generally, they'll accept a photograph of those things being in place and they won't have to come back out to visit. Some appraisers need to come out, some lenders need them to come out. Just depends on the lender you're using. Sometimes photographs will do. They could also say in a VA loan, not uncommon for them to call out, well, there's dry rot on this window, you need to repair this window. Or some house repair needs to get made before they're willing to sign off on it, in which case that needs to get repaired and something needs to get photographed or they need to come back out to see that the work was done. The appraiser called out conditions, okay? Or they don't. They say it's in at value, no conditions. Yay! Everyone pops some champagne and the loan can move on to underwriting. But that's your appraisal, okay? The appraisal is the bank's assurance that they could sell the house for what you paid for it should you default. They need that assurance. The appraiser is the one that gives them that insurance. If you have questions about that, because it is not the simplest process, it is not the simplest thing to understand. I totally understand. I'm happy to answer any questions you have about it. Give me a call, comment below, share this video, let me know what you need. Aaron Hendon with Christine and Company over at eXp Realty. Talk to you soon.